there's a misconception that people have when you set up a corporation that you're actually protected.
Shutting your corporation down means you don't have to pay the corporate tax. CRA is not coming after you. It's only corporate. But the HST and the source deduction is 200 grand. And that one is yours personally. Yeah.
Welcome to the Clinic Boss Show, everyone. We got Scott Terrio. He is a consumer insolvency bankruptcy expert. Did I get that right, Scott?
Yeah, that was pretty close.
Okay, maybe you can share with people. Like, I'm super fascinated with this. Why don't you share with people, like, what is it that you actually do, and who actually comes to you? You know?
Yeah. So, okay, I spend my days speaking with people who are in debt trouble. Lots of debt trouble, various debt troubles. It's all consumers. We don't do any business work. We do a lot of work with people who own businesses, and their businesses are either failing or have failed or closed down. And now we're going to deal with the personal stuff. But it's all personal consumer debt, credit card debt, line of credit, tax debt, lots of tax debt, student loans, payday loans, all that stuff. And when people are at the point where they can't pay those anymore, and they've probably spent, 6 months to 18 months agonizing over it, they call us. And so we talk to them and say, okay, let's look at the problem and see if there's something that we can do about this, either under the umbrella of the consumer insolvency law options, or if it's something that they can do themselves, then we tell them that too.
Wow. Wow. And I think we were just talking before the show, like, you're super, like, slammed right now. Your schedule, like, it's just like, I
Yeah.
guess,
Well,
are you saying that, like, consumer insolvency is at a record high right now, like in Canada? What are you seeing right now?
Well,
It's trending.
statistically it's almost back there. Yes, and it's like it was really high when there was a record in 09-10, and then it went down again for a good decade. It went back up just before COVID. It was spiking again after a long run of, not really having a lot of filings, to be honest. And then COVID knocked it right off the charts. It just dropped like a stone. And now it's back to what we're seeing now is this is going to be a big wave. Consumer insolvency filing waves typically are short. They're a couple of years and the reckoning is done and all the kind of the bloodletting is done. This one's going to be long because it's going to involve all kinds of people because of all various factors, macroeconomic and otherwise, that have happened in the past 5 to 10 years. And so the vortex is pulling everybody in: homeowners, business owners, all kinds of people. So yeah, I've never been this busy.
How much of that is, you think, is because of some of the macro stuff, like post-COVID, like the over-leveraged, like, real estate market, all this tariff stuff that's now starting to impact, like, business owners, and yeah, how much are you,
Yeah.
is that you're seeing a lot on your plate right now within the biz?
Yeah. So in the last 5 years, like since COVID, so COVID was a disaster for a lot of people, depending on what industry you're in. So if you were in any kind of, contact with people industry, I'm sure you know this from clinics.
Yes.
Like,
Oh my
you know,
gosh.
I've spoken to so many people who own clinics, who, come into contact with humans, who are servers, who are entertainers. All that stuff got crushed in COVID. And, it didn't get better for a while. Like COVID was long for those people, right? Because, you'd have another wave of COVID again. Okay, we had a year and now we're working again. Now we're not working again. And so they're collecting CERB. And then the first wave of CERB wasn't taxed. And so now they owe tax on the CERB debt, or the CERB benefits they got. And then the businesses got benefits as well because of COVID as well. So then all these things happen. And now industries that have started to recover are faced with all the stuff we're seeing now. Generational inflation. Oops. The more recently, the whole tariff situation, which is going to take time to play out. And that's why I think this is going to be a very long, wave of insolvencies, or at least people with a lot of debt they can't deal with, because you're dragging behind you all this consumer debt from the last decade, which homeowners could get out of because they were homeowners. As your equity is going up, and you get a bunch of credit card debt or tax debt, okay, you just take out an equity loan or you refinance your house. Well, now everybody's equity has dropped, or a lot of people's have, certainly condo owners, homeowners in a lot of places. And so they're losing those options. And so then, therefore, they call us and they say, like, hey, I didn't need to call you for 10 years, but now I do. So all these things are coming to kind of a head right now. And if I could have designed almost a perfect financial storm 5 years ago, this might have been what it looked like if I'd have been smart enough to figure it out. So
Wow. Wow. And so
yeah.
and so what and how much of that is because of the like over leverage in the real estate market, or is it the credit card debt?
Well, it's both, because we study our clients every year. We do about 4,000 filings a year, and that's a lot. And we study those every year and produce a study called Joe Debtor. And every Joe Debtor we produce shows the same exact trend, which is homeowners have much more credit card debt than renters. So if you're a
Interesting.
homeowner and you come to me, you've got 90,000 in unsecured debts. If you're a renter, you got 65,
Okay.
maybe 60. And the reason for that is you're more creditworthy. Like you
Sorry,
have
is
more
that
expenses.
90,000 credit card, or is that 90,000 a credit card and line of credits? Like, is that
Everything,
are you?
all
Okay.
unsecured, so mixed,
Okay.
whatever, right? But
Right.
homeowners always have substantially more unsecured debt than renters, and that's for two reasons. One is they got more expenses owning a home, and two is they're more creditworthy, so the banks will give them more rope. And so, we don't have homeowners come to us with tiny little bits of credit card debt. It's a lot. And so now that the homeowners are losing their options that they had for the housing boom run up when they didn't need us, I didn't talk to a homeowner for 10 years.
Yeah.
And now it's half the people I talk to are homeowners, right? And in the last 12 to 18 months, it's going to get a lot worse. And that's a bunch of reasons. Number one is their equity went down because the housing market slumped. Two is they're faced with renewals they can't handle because when they got in, money was free. Well, now it's 3%, 4%. Like you're doubling your payments. People can't handle that, right? You got inflation
Right.
you're
That's
dealing
right.
with. So
Yeah.
yeah. So that's the problem now, is that you've got all these other macroeconomic problems, plus you're renewing your mortgage. And so therefore a lot of homeowners are just kind of throwing in the towel.
Yeah. And then, yeah, that's kind of heartbreaking, like going through that. And then how have you seen that translate to, have you seen a lot of cases where it's the homeowners and the business where like they max out, like
Mm-hmm.
my assumption is that their unsecured credits also at maxes are using that to actually like start their business or run the business as well, right? Are you seeing a
Yeah.
lot of those cases as well, or what would a
Yes.
typical
Yeah.
scenario look like?
So small business owner, often either a tradesperson, like a painter, a welder, a roofer, or a general contractor. Maybe they're incorporated, maybe they're not, but they went through a whole bunch of really rough patches. And as entrepreneurs, business owners, if you don't want your business to shut down, you don't want to fire everybody, so you keep it going. And one of the ways that they do that, unfortunately, is by not remitting tax, because they're not paying their HST or their source deduction, payroll deduction,
Yeah, yeah,
because they're holding on to it to keep the business going, and I'll pay it someday, right?
yeah,
Or they borrow personally, and they oftentimes put their personal credit cards and personal wealth against the business. And okay, that can work for a while, but if things keep going badly in the business, it just gets worse. And then what happens is you end up owing too much that you can't deal with, instead of owing a little bit from 3 or 4 years ago. And we typically see people who are really good at what they do and really not good at the books, right? Because nobody
mm,
tells you stuff. Like, what course do you sit down and take from either the government or whomever when you start a business to make sure your taxes get filed and paid? No, nothing, right?
yeah,
There's nothing. You're just out there, right?
yeah,
And oftentimes it's your spouse or whatever that's doing the books. Okay, well, they may or may not be a professional accountant, and
yeah.
it doesn't take long to get into a
Or
big
your
pile of
office
trouble,
manager
right?
doing it, right? And then
Well, or you're doing it at night, like when you're exhausted, right? So this is the
yeah,
problem: is that people aren't set up to do the administrative side. They're great at what they do, right? But they're just
yeah.
not set up to do that, to deal with the taxes, and then they run into trouble. And okay, well, I got to do something to keep the business going here.
Yeah. So it sounds like it's these unexpected expenses that pop up, right? That usually triggers like
Mm-hmm.
these type of insolvencies because they're like, oh my gosh, I
Mm-hmm.
didn't know I owed like, $100,000 of like taxes to the government, right?
Yeah. Yeah, I mean, sometimes it's just totally not knowing. Other times is it, but what are you going to do about it? Like,
Yeah.
your business you're just making payroll, right? You're exhausted. Maybe there's been a rough patch in your industry, right? Like talk to anybody in construction right now, right?
Yeah.
Condos are stopping, the cranes aren't moving, right? Like it's just all
Yeah.
this stuff happening. And so, and you owe HST and you owe payroll tax to the government. You haven't been remitting it to keep your business going. Okay. But I owe 100 grand, but I can't pay it.
Yeah.
So do you shut the business down and throw in the towel? Most people don't. Human nature is keep going. And those kind of things don't get better with time, right? Like owing debt, time is the enemy of debt, right? So
Yeah.
it just keeps
Yeah.
getting worse. And what people don't understand is technical stuff. And by that, what I see a lot of is people not understanding that they are personally liable for a lot of business debt, right? Even though they're incorporated, which is legally separate. The whole idea of corporation, Latin for corp, is you are separate from the business. But there are things you're not separate from, right? HST is director liability debt. Payroll tax is director liability debt. So if you close the business down or it goes bankrupt, the CRA will come after you personally for those things.
Yeah.
Likewise, if you sign personal guarantees for business debt, which is almost always the case,
Your
because what
leases, right?
what big bank's going to give you 200 grand
Yeah.
without, they know how corporations work, so they know
Yeah.
if you close that corporation, they're out of luck, so they're going to get you to sign a personal guarantee. Half the people don't even remember signing personal guarantees because it was 10
Yeah.
years ago, and I don't know, they put this document in front of me and I signed it. Okay, well,
Yeah.
now you and your wife owe whatever, right? So that's typically, it's not understanding the technical parts of what they've set themselves up as, because they're not necessarily business people, they're contractors, or they're good at what they do, right?
Yeah. Well, I think you got this nailed down. So these type of so what you're saying is that I think there's a misconception that people have when you set up like a corporation that you're actually protected, right? In reality, is that you signed up all there's the taxes to the government, there's all these personal
Mm-hmm.
guarantees, whether it's to the line of credit or maybe it's
Yeah.
to the mortgages or maybe even to the lease, like the lease that you have on your property, right? Like the lease
Yeah.
for that your physical
Almost
therapy
always
space, right?
personally
Which is
guaranteed. Yep.
yeah, which is 20 years. It's
And
a
it's
10
six
year
grand a
lease.
month. Yeah. So do the
Yeah,
multiplication.
yeah,
Yeah. It's, yes. And I just lost my train of thought there for a second, but, when you set up a corporation, you personally are separate from the corporate debts, period. But not all debts are just corporate. That's the problem, right? So I have people who owe corporate tax. So they owe HST, they owe payroll tax, and they owe corporate tax. Okay, shutting your corporation down means you don't have to pay the corporate tax. That's it. Just walk away. CRA is not coming after you. It's only corporate. But the HST and the source deduction is 200 grand, and that one is yours personally. Those are director liability
oh,
debts.
that's right. The
So
source
the
deduction,
the,
the
the
source deduction of all your staff, right? Is that right? Yes, right.
payroll tax.
Payroll.
Yeah, I should
Yes.
I should call it that, because that's what I'm using
Oh, that you
a
know what?
industry term. But yeah, payroll tax.
Oh, geez, I didn't know that. You're right. That's a big liability, for sure, right?
It's oftentimes the biggest, and there's other problems with it too. From a technical side, I don't want to get into this too much, but if you owe a ton of payroll tax, that's a super priority tax. It's called a deemed trust.
Okay.
So let's say your business is closing. You called me, you go, Scott, I got to do a personal filing. I'm shutting it down. Okay, cool. Close your corporation down. You don't owe the corporate tax because it's corporate. You do owe HST 100 grand and you do owe payroll tax 100 grand. The issue is the payroll tax is considered a super priority tax under the insolvency law. And so that means you got to deal with it in a different way, and it's much more risky, and it's much more problematic. So tell your people, or I'll tell them, if you're going to owe a lot of tax debt, make sure it's HST instead of payroll tax. Okay. So because if you have to pick the two and do an insolvency, you're going to have much worse options if you owe a bunch of payroll tax than if you owe HST, even though they're both director liability debts.
Interesting. Cool.
Yeah.
Hey, Scott, maybe you could tell the listeners, what's the difference between insolvency versus bankruptcy, right?
Bankruptcy is insolvency. So
Okay.
insolvency is bankruptcies and proposals under the Canadian bankruptcy law. Okay. It's worked different in the States. So don't read anything about American bankruptcy code. It's totally different. I
Okay.
mean, in a nutshell, everything in the States is a bankruptcy. It's just a form of bankruptcy. In Canada, you can either file a bankruptcy or what's called a proposal, which is a legal settlement with your creditors that you make through a trustee, through the courts, but it's in
Okay.
lieu of bankruptcy. Okay. And
So
90%
insolvency
of
is
our
before
files are
bankruptcy in
proposals.
Canada? So insolvency is a proposal.
Insolvency is both.
Okay.
A proposal is an insolvency, a legal insolvency, and a bankruptcy is also a legal insolvency. They're both insolvency.
Okay.
Okay. They're just two different provisions for what you can do with your insolvency filing. Okay. So you can either file a bankruptcy or a proposal. Almost everybody does a proposal if they can, because the credit rating is better, and it doesn't have all the risks and all the rules of bankruptcy, and you don't have to spend the rest of your life telling people you filed bankruptcy. If they asked you, if 10 years from now your bankruptcy's long gone off your credit report, and I say, hey, Rick, have you ever filed personal bankruptcy? And you sit there going, I got to tell him yes. I have to say yes, because I
I'm so
did. And if he
embarrassed.
looks it up, well, because here's the problem. It drops off your Equifax and your TransUnion report, but it doesn't drop off the system. And I can
Right.
do a public search for $8 and find out if someone I'm interviewing is lying to me about whether they've done bankruptcy or not. Okay.
Okay.
So in that sense, bankruptcy never goes away. Now, it doesn't mean you can't get credit, because at that point you have no debt, right? So technically on paper, Rick may have filed bankruptcy 10 years ago, but he's got no debt. Right. And the other 10 people that applied to me for that loan today are all up to their necks in debt. So as a credit risk, you're probably good, but technically I can still look your bankruptcy up long from now, forever.
Interesting. It's like a criminal record that follows you, right?
Well, yeah, I don't want to make too much of that, because not everybody does those searches. But I make sure people understand that when they file one, right? Like, I'm telling you that this is something you may face, right? So therefore you make a decision with your eyes open.
So Scott, can we run through that scenario? Like, let's just say I'm a small
Sure.
business owner, right? Like I own a clinic, physio, chiro, massage, dentist, whatever. And yeah, the business is not doing so well. I got a bunch of consumer debt,
Mm-hmm.
mortgages,
Yep.
like blah blah blah. Like
Yeah.
I'm over leveraged, right?
Mm-hmm.
Can you maybe go through what that process looks like of
Yeah,
insolvency that takes you right to bankruptcy? Like just to paint that picture.
for sure. So you come to me and you tell me what you just said, right? You say, okay, business is no longer viable. That's the first question I ask. Like, are we talking about a business that you can keep going somehow here? Because if so, that's maybe different what we do. Let's say it's not viable. You're throwing in the towel. That's it. You're done. Insolvency, whether a bankruptcy or a proposal, deals with unsecured debts only, right? Because secured debts have the asset. Okay, so your mortgage, your car loan, we don't deal with those, because if you don't pay them, the bank or the lender gets the asset. Okay, now if you give that asset back, either voluntarily or not voluntarily, and there's a shortfall, the shortfall is unsecured, and we can deal with that. So oftentimes what we'll have is, people they can't pay their mortgage. Okay, so they walk away from their mortgage. The bank sells the house, and there's $100,000 shortfall, like the difference between what they got for the house and what was owed on the mortgage, right? That goes into the pot with all your other unsecured debts, and we get rid of that. So even though there's full recourse to mortgages in Canada, except for Alberta, insolvency can deal with them. Okay, that's a big thing. But if you come to me with this set of debts, you have tax debt, credit card debts, all this stuff, personally, mind you, because we're doing a personal filing, remember? You're closing your corporation. The corporate debts die when you close the corporation. Well, okay, someone's going to jump on me here. Technically, you can't close a corporation that has debt, but doesn't matter. It's not operating. So who cares? You just set it aside. We put in all the tax debt that comes to you personally from your business. So director liability debts, HST, payroll deduction, like we talked about before, and any personally guaranteed debts from the corporation, right? Because if you sign a personal guarantee, like say BDC, Business Development Canada, gives you 200 grand for your clinic. Okay.
Free
And
money.
your clinic fails. BDC was smart enough to make you sign a personal guarantee for that. Okay. Almost 100%. So your BDC tries to go after the corporation. Can't. There's nothing there. Corporation's closed. There's no money. It's broke. It's done. So they'll come after Rick because they got his little signature in the bottom corner, and maybe they got his wife's too. So they come after Rick for whatever the remaining debt is personally. Well, we're doing a proposal or a bankruptcy. So sorry, it's in there with all his credit card debt, his other tax debt, etc. So in other words, we take all your personal debt, we make a list of it. We say, how much is this? How bad is this? And what are we doing? Bankruptcy or proposal gets rid of all the unsecured debts. Make sense?
Yes. Yeah. Yeah.
And the only difference is in a proposal, you're making a settlement. So instead of doing bankruptcy, you got 60 months, 5 years to pay X dollars a month to all the creditors combined. So one payment, all the interest stops, and the same stay of proceedings that you get from the bankruptcy, the same protection is applied to you, so they can't come after you outside of the bankruptcy or the proposal,
Can you
right?
say
So
that
you're making
again?
a structured settlement over
Can you say
5
that again?
years.
Okay,
Yep.
structure. So it's so there's are those unsecured debts like reduced, or is it the same amount
Yeah.
spread over
Well,
5 years?
typically, not
Okay.
not as a rule, they're reduced because what we do when we file a proposal, we calculate a hypothetical bankruptcy filing first, because bankruptcy costs money in this country. And
Okay.
that is based on three things: based on your assets, your net monthly income, and if you've ever filed a bankruptcy before. That's it. So when you come to me with your set of debts and your clinic is closed and you got 200,000 owing, whatever,
Okay. 200,000.
um, your proposal is not based as much on the 200,000 as it is on your assets, your income, and any prior bankruptcies you filed. So that's where the reduction comes, because if you're not making much now, you closed your clinic. Okay, I went to work for a clinic because I know clinics, and they hired me on payroll. So my clinic's toast. Okay, now I got less stress because I'm on payroll. I don't have to run a business and make payroll all the time, right? So I'm going to go be a chiropractor for somebody, right? Make 100 grand, let's say. Okay, well, now your proposal that you're going to make is based on what would they get if you did bankruptcy with the income you have now, with the assets you have, and if you had any prior bankruptcies. So in other words, there's a formula for how much a bankruptcy costs,
Okay.
and you have to offer more in a proposal, because a proposal is 60 months and a bankruptcy is either 9 or 21. So in other words, if you're going to get 30 grand from me in a bankruptcy, Rick, as creditors, and I say, you know what, Rick, now I don't want to do bankruptcy, I'm going to do a proposal instead. So I'm going to make you wait 60 months potentially. So I'm making you wait 3.5 more years. I better sweeten the pot because you're going to approve the proposal, right?
Right.
Bankruptcy, nobody approves it. You just file it and it's math. In
Right.
a proposal, you need 51% of the creditors by dollars owed to say yes for it to go ahead. So I have to make you enticed to like the proposal
Okay.
because I'm making you wait longer to get your money, right? So in other words, if your bankruptcy was going to be 30 grand, I don't know, you give them 40 grand over 60 months. What's that? 700 a month?
Okay.
Something like that. That's really quick and like super fast 101, right? But that's what a proposal is. It's a settlement that's legally binding through the courts once the
So,
creditors approve it.
and is it you negotiating with each of the creditors? Is that how that would work, Scott?
As a group.
Okay.
So I take your list of 200 grand, let's say it's 6 banks and CRA, okay,
Okay.
and they all have a 45-day period to vote. And
Okay.
I need $101,000 worth of the 200 grand to say yes for it to go ahead.
Okay.
Now the other 99,000 are in anyway.
Yeah.
So you can't opt out. You can only say no to the proposal. It's like an election, right?
Yeah.
If you didn't vote for the guy that got in, you still get him,
Yeah.
right? So it is a way for you to get out of your debts without doing bankruptcy that gives you a structure and stops the interest. Okay.
Right.
And yes,
The
you
purpose,
end up paying a portion of it, right?
so I get it. So, in essence, like the purpose of the proposal is to stop the paying the interest and also negotiate so then the amounts are lower as well. Is that right, Scott?
Right. And it's also to stop them taking action against you, right?
Okay.
Because they can all take you to court and they can, garnish your wages. They can put a lien on your house. They can freeze your bank account, right? And CRA can do those things without going to court. So it's also giving you protection and peace of mind, because people who
Right.
come to me haven't slept in a long time.
Oh yeah.
Okay.
Yeah.
Right. And they're fighting with their wife and their kids aren't happy with them. And so all that stops because most of the source of that is financial stress, psychosomatic, right? People are
Yeah.
sick.
Yeah.
So the other idea here is to give you space, right? And
Yeah.
protected space as long as you pay your proposal payments, Rick, you're good.
And what type of reduction typically do you see? Like if I owe
It
200,000,
depends on what you own, how much you make, and prior bankruptcies.
okay.
So it can be massive, like it can be 80%, but
Oh shit.
everybody's set of factors is different. So if you have no house,
Yeah.
no investments,
Yeah.
and you're working, as I said, you're working as a chiropractor for 50 grand for that guy you knew, okay, because you're in
Yeah.
the business, so you knew lots of guys, so you're working on payroll now.
Okay.
Okay, you have no prior bankruptcies, you got no house, no investments, you're making 50 grand. I punch 50 grand into my little computer that says, okay, here's what he's making in net monthly income. In that case, it's probably what, 3,000 a month
Yeah.
depends on how many people in your household. You could have an 80% reduction plus all the interest.
So if you're
Or
poor,
you could,
so if you don't have a lot of net assets, you don't make a lot of money, then you could see a big reduction. But if you're actually sitting on a lot of like,
yeah.
like assets, right, and income.
Here's the way to think of it. If you're a guy who coaches a lot of clinic owners, and your name's Rick Lau, what you're
Ah,
telling them
jeez.
is keep all your assets in your wife's name, okay? Because 5 years from now, there's a question that I ask people when they file a bankruptcy or proposal. It's the same question, regardless. Is in the last 5 years, have you transferred any assets? In other words, have you put assets beyond the reach of creditors?
Yeah.
And if you say yes to that question, okay, now it's in play. So let's say last year you transferred your 50% of the house to your wife, and that house has got 600 grand worth of equity, Rick. Now the creditors are going to go, where'd the 600 grand go? Or where'd your 300 go, Rick?
Yeah.
Now you're filing a bankruptcy or proposal, and you just ditched your house. So there's a 5-year period. The best answer to that question is the house has never been in my name. Great, excellent. Okay, so in other words, you're keeping your personal assets out of your name. They're in your wife's name or your husband's name. Okay, and that way, that doesn't come into play as a factor determining how much you're going to pay in a bankruptcy or proposal.
Okay.
So there's
Wow.
a 5-year clawback or review. They're called reviewable transactions. Okay.
Yeah.
Now, some assets are totally exempt. You could have $10 million in an RSP, Rick,
Yeah.
personally. And if you haven't contributed to that in the last 12 months, I can't touch it. It's not like a
Oh,
house equity. It's exempt. Okay. So there are exemptions.
okay.
And that's the big one. Is the RSP thing is a big deal because it's a registered product. And if you haven't, the reason for the R12 contributions thing is you can't go and stuff your RSP and then call bankruptcy. Okay. Right? Like
Right.
I put $1 million in my RSP, I'm going bankrupt.
So
Screw
with
off.
the RSPs, is 12 months? Is that what you're saying? Like that's the
12
window?
months.
Okay.
So if
What
you
about a
haven't put
family
a
trust?
cent in 12 months, doesn't matter.
What about family trusts? Is that
Trusts are
protected?
exempt because they're not yours. They're for someone else.
What
Okay,
happens
they're in
if
your
it
name.
was? What happens if it was put together like there was what was if it was put together in the last like within the last 5 years?
Well, okay, so if you set up a trust, 6 months ago, you got a problem, obviously, right? So there
Okay.
again, you're back to yes, trusts are exempt because they're not your asset, right?
Okay.
But if I can show the creditors, or the creditors can say, well, wait a minute, didn't last
Okay.
month he set up a trust? Okay, yeah. So it's a
Okay.
good question, but yes, okay. I think the key to cover all of that is the 5-year thing, right?
Okay. Okay.
If,
So
in other words, if I'm opening a clinic, say I'm new and I'm gonna start a clinic, great. Okay, the first thing you do after you incorporate is put all your assets in your spouse's name.
or a family
Because
trust.
whatever, right?
Yeah.
Because chances are you're not going to be talking to me for 5 years because you're going to start your business. It's going to take you 1 or 2 years to get it going. You're going to
Yeah.
make money for a couple of years and then it's going to go bust in a year. Okay, that's 5 years is gone, right? Like
Yeah.
seriously, right?
That's
If you're
true.
going to run into trouble, it's going to take you 5 years to get into the scale of trouble you need to speak to me. So if
Yeah.
you open your clinic, the first thing you should do is think, okay, I don't want to have anything in my name in
Yeah.
case this blows up, right?
Okay. That's good. That's good. Scott, you should be one of our coaches at Clinic Accelerator. You will handle the insolvency department.
I charge an enormous amount, Rick.
Hey, we're talking about a lot of money. You should charge a lot of money, right?
I'm just kidding.
Yeah. So, wow, this is fascinating, this whole process, right? And so,
Well, I just think it's unknown, right? It's not something
yes.
that, like, before my previous life I worked for John Deere for 14 years. And now I've been doing this for 15. So I've had like, half my career has been one thing, one another. And with John Deere, I was a territory manager, which means I called on a set of dealers in out west and in Ontario, both different times. And a couple of those things went bad, right? We had a couple of dealers that failed. It happens from time to time, right? And
Yeah.
so I saw businesses close down firsthand because when a John Deere dealership goes down, everybody's involved, right? And so, but even through all of that, I knew nothing about this business until I got into it. Nothing.
Yeah.
And that's why I think the public generally doesn't have much idea of how this works. I don't blame them. Why would they, right? And so I think if you know some of it, and especially the business law stuff that we talked about first, understanding when you set up a corporation, what are you doing? Well, I incorporated because my accountant said it was tax beneficial. Okay, yes, but it also, you're legally removed from the business. Whereas if you're a sole proprietor, you're not, right?
Yeah.
So, okay, what are the advantages of that if things go to hell? Okay, well, I can just, either close the business. You can't close the business with debt. Don't jump on me for that. You can stop operating the business, and all the corporate debts aren't yours because they're corporate. It's separate.
Yeah.
Now, most people, when they set their corporations up, did so because they got above a certain amount of income revenue, and then they just set up a corporation. They didn't really know why they did it, or didn't look down the road far enough to think about what we're facing here. But that can be used to your advantage, right? Because all the corporate debts we don't have to deal with them in a personal filing. But there's a lot of things that are personal that you can't escape from, even though you're incorporated. That's the thing to know.
Yeah. What is it?
And, sorry, one other thing that's important. I made some notes on this. You can be, let's say you have partners. There's two of you. That payroll tax that we talked about, an HST, is director liability. Now, Rick, as a shareholder, are you necessarily a director? No. Right? A corporation must have one director, minimum. But both shareholders can be directors. All of them can be directors. And for the period in question, for when HST is owed and payroll tax, those directors are liable. Now, you could have been a director and resigned your directorship, but your buddy, your partner, is still the director, and the HST, the 200 grand, was owing after you resigned your directorship. That director liability is his, not yours. So smart shareholders aren't directors when there's things are bad.
Oh, geez.
And you'll see that a lot in business history, like the really smart business people. I'm not a director. Hey man, I don't want that. And people are like, oh, why not? You can direct the company. Yeah, but I'm not going to be there when the shit hits the fan. Sorry. Yeah. So remember that it is director liability. It's not shareholder liability, right?
But
that's
if
important.
You're a director liability, like you can also purchase director liability insurance, which does protect.
Yeah, you can, but that's expensive. Yeah. Cheaper to just not be a director.
Yeah.
Right.
Well, with our business, we actually do have director liability insurance. But yes, I totally agree.
And you're right. I know
it
that.
Is very expensive.
I get that.
It is very
but it's
expensive.
it also, you know what? It also doesn't always cover everything, right? Because insurance, the nature of the business of insurance is, okay, when things go bad, the insurance company goes, okay, what do we not have to pay, right?
Yeah.
And so every form of insurance since history, since the pyramids, has been like that, right? And so you got to be careful because you might have paid it for years, but like credit card insurance is BS. Okay. And I've said this on BNN Live before and gotten lots of mail from it. But like, you know, you pay through the nose for a bunch of years and then they find 20 reasons they won't pay it. So, you know, just keep in mind that it's not infallible, right?
So good tip from Scott, you know, don't be a director. If you have a business,
or at least if you know things are going to go bad, make sure you resign your directorship before the.
If you are going to be a director, at least get paid more if you have a business partner, because
maybe that's part of your thing. Is like, look, I'm taking on risk, right? I want more money. Okay, cool, whatever, right? But
wow. And what does life look like after like the proposal? You know, right? So the proposal said, oh, like, do you get like a stamp on your face? Do you get a stamp on your record that follows you? Is it hard for you to get like loans and all this other stuff?
Let's be specific and technical, because this is what I tell people. Because people come and they say, am I going to be ruined for life? Okay, that's a subjective word. Doesn't mean anything. When you file a proposal, you get an R7 credit rating on the transaction history element of your credit input score. What the hell's that mean? Okay, so you have a 3-digit score, right? Everybody does. And it's made up of 5 inputs. We know how much percentage each is, but we don't know the formula. And they're never going to tell you because they don't want you to game it. So transaction history is the single biggest weighted input of your credit score. It's 35% generally. And when you do a proposal or bankruptcy, you get a rating code on that, which is an R9 in bankruptcy and an R7 in a proposal. So what that means is you get that R7 in the proposal for a maximum of 6 years. So if you go the full 5 years of the proposal, it's +1. 6, and then it's gone off your credit report. Okay. Now, the other thing is it can only be on your credit report for 3 maximum when you're done, and the proposal is fully open terms. So it's a 5-year proposal, but you can pay at any time, either gradually or, I don't know, your Uncle Jimmy dies and leaves you 50 grand. You walk into the trustee's office, say, here's 50 grand, I'm done. So then it's on for 3 years after that period. And again, maximum 6. So you can do the math, right? So it's there for a while. But what does it mean? Well, at the end of your proposal, how much debt you got? None, right? Okay, and you're gainfully employed, and maybe your wife is too, and maybe you put your house in your wife's name because Scott told you to 5 years ago, and so you're not doing too bad, right? You got no debt, which almost no Canadian has, or is of a certain age bracket, and you know what? You're living your life by cash flow instead of by credit, so that's not bad. So we have people all the time who are done proposals who tell us, yeah, I'm doing pretty good. Like, now bankruptcy is a little bit worse because it's more harsh on your credit, but it's still, they both achieve the same thing, which is getting rid of your debts. And some people don't care. Like, they have so much debt that I just can't do this anymore,
again.
right?
Yeah.
Can't do it. Yeah.
Wow.
So it's not the end of the world.
Yeah. So it sounds
but
like it
you know
resets.
what? It's not the end of the world. But when you're in as much trouble as people are who phone us, you're not faced with ideal choices, right? You're picking the least crappy choice from a bunch of crappy choices, basically, right? Oftentimes that's a proposal, but sometimes it's bankruptcy because sometimes it just makes more sense to file bankruptcy, right?
What what would you say are the top 3 red flags that someone's heading into insolvency?
Business-wise?
Sure, like a business owner, right?
Okay. Probably taxes. If you're starting to tread water on paying HST, keeping up with your remittances or your filings or both, that's usually a signal that if you're using tax money to keep your business going, you got a problem, and it's not going to get better. Likewise, if you're pouring a bunch of your personal debt or equity into your business, bit of a red flag, right? Because if the business can't make itself go, probably not getting better. And if you see something coming down the road that is going to impact your business that is beyond your control, like COVID,
or the tariffs,
right? Or tariffs, sure,
yeah.
Or inflation, right? Like all that stuff right now is making people reconsider businesses that they opened before that happened, right? So they opened their clinic 4 years ago, 5 years ago, 6 years ago, and we've had a once in a lifetime pandemic, or hopefully once in a lifetime, generational inflation. We've got an America that has decided they're going to charge everybody for everything. And they're actually charging themselves, and they don't understand that. But okay, that's fine. Still affects us. All these things are happening, and we're probably in a recession, or we're going to be, and possibly massive job losses. What's that?
We're probably in a recession right now. You agree?
Well, I think we've been in a recession, effectively a recession, for a long time because it costs me $1,100 a month for groceries, and it used to cost me $700. To me, that's a personal recession. There's a saying right now, Rick: Canada's not in a recession, but Canadians are.
Yeah.
Right,
well,
and so I think recession's up here, right? It's not just it's your outlook. And an outlook isn't
it's
great.
also recession per capita, because if you look at all the immigration numbers over the years, like if you look at
it's
GDP
been masked
by the number of per capita, like because we got a flood of 2-3 million people coming in a year, right? Then we are in a recession right now. And I think if I look at what you told me earlier, like the firm that you work with right now, you guys are seeing record spikes in personal insolvency, right? So it's kind of pointing in that direction, right? And I'm personally worried about the personal well-being of a Canadian consumer right now, right?
The way I think of it is, I'm glad I'm not in my 20s or 30s, Rick, and that makes me a bit sad, because every generation is supposed to do better than its parents, right? And I wonder if society hasn't peaked in that sense. Like every generation did better, now not so much. So is that going to continue, or are we going to fix it, right? So I don't know. Right now it's not good. So
wow. And then, and what would you say are the, what other tips outside of what you shared already, that maybe like a business owner could protect themselves today, right? Given that this this world, this new like economic world we live in, and yeah,
Hmm.
and how to not
Well,
protect yourself from that root of insolvency, right?
we talked about the assets and that stuff, and doing that from when you open your business and all that stuff. But I think also recognizing earlier that your business isn't going to be viable because people hang on. Okay, and so when a business owner calls me, when a non-business owner calls me, someone that has never owned a business, they're just working on payroll. We figure based on lots and lots of filings that people wait between 12 and 24 months to call us when they first realize they're in trouble that they probably can't get out of. And with a business, that can be 3 years. And in that 3 years, things only got worse. So I think you need to be very honest with yourself when your business is not going well and hasn't been going well for a while. You're better off to shut it down because time, again, is the enemy of debt, right?
Mm.
When you have a lot of debt and your business is floundering, it ain't getting better a year from now unless business goes up a lot. And if you can see something coming that's good, great, that's different. But if things aren't looking like they're better on the horizon, and you owe 100 grand in HST and 50 grand in payroll tax and corporate tax, and your BDC loan is behind, all that stuff, are you really going to pay all that?
Yeah.
It's always better to call us earlier as well. If you're ever going to call a trustee, you don't have to file insolvency. Okay? I don't grab your leg and shackle you to the wall and make you file insolvency. That's not how this works, right? 60% of people that call us don't file anything. It's
Awesome.
free advice. Everything I
Yeah.
just told you for 41 minutes was free if you call us. And it's free if you call me 10 times. Unless you file a proposal or bankruptcy, I don't get paid anything.
I
Okay.
hope to never call you
So
Scott.
if you call us and tell me, here's my set of circumstances, I'm going to tell you all kinds of stuff. And you might not file anything, but you're probably going to do better off because here's what you should be doing and whatever to protect yourself, right? Get a different bank, put your assets in your wife's name, whatever. Like, we're going to tell you stuff, okay? I'm not going to
Yeah.
tell you to put assets beyond the creditor's reach because I'm an officer of the court. I can't tell you that, but I can tell you all
Yeah.
kinds of stuff that will help you get through, even if you don't file an insolvency.
I think you
Sooner's
brought
better.
something. I think you brought something really important. Like you got to recognize when to cut your losses, right? If you
Yes.
recognize your business is not viable,
You said it better than
and
me. Yep.
yeah, and like your cash flow is just like your cash flow tells the whole story,
Yep. It's always cash
and
flow.
yeah. So if you can't meet your cash flow and the business isn't growing, right? Um,
Yep.
and you're obviously having a lot of stress, like financial stress, which is impacting marital stress,
Yeah.
family stress, the whole,
Yeah.
like I've been through that journey and it is stressful, right?
Yeah.
Um,
People are in terrible mental condition when they call us oftentimes, right? Their marriages are bad and their sleep is bad, their health is bad.
yeah,
So if all that's happening to you, the sooner you call somebody, the better.
yeah,
Because it'll make you feel better just calling somebody. I can tell you that. Like I had a chiropractor who called me 5 years ago, and she just called me again last month. She didn't file anything. 5 years.
yeah,
She's in my
awesome.
system. So when she
Yeah,
phoned, I was like, okay, how's it going? What's going on now? So even if you phone and don't do something, it can oftentimes either make you feel better or help you to know, okay, here's what I shouldn't do, right? To
yeah,
make this worse or whatever.
yeah, yeah. I love it. Yeah,
Like a
it's
doctor doesn't
interesting.
always do surgery on you. Sometimes they just say, okay, well, stop drinking or something, right? Like stop
Yeah,
smoking, right?
yeah. Yeah, I think over the years with social media, as people's there's a big um, um, everyone wants to be like an entrepreneur. Everyone wants to start a business now. Like people don't want to be on payroll, And so you're seeing this trend of all these, you see all these social media people, YouTubers, like they're making all this money, like starting a business. Everyone
Mm-hmm.
wants to be like a business owner, and what I've seen over the years is not everyone is cut out to be a business owner, right?
Oh God,
I
no,
think they like the
no.
idea of doing business, but are you willing to put the work and be able to like execute and
Mm-hmm.
actually do the grind and go through that
Mm-hmm.
volatility of higher highs and higher lows, like, and can you get out of that and actually have a cash flowing business? If you don't, it's probably better that you stay as an employee, make good money,
Mm-hmm.
and like do your RSPs and just get really good with buying like some ETFs that give you 10 to 15% a year, and you're probably way ahead
Yep.
than trying to be a business owner.
Yeah. Well, you know what, we always think too that in the year 2025, like there are more entrepreneurs or self-employed people now than ever. But part of that is because of the way the world is, right? Like you don't go and get a job like me at John Deere when you're 26, making great money with great benefits for as long as you like. Okay, that doesn't happen now. So people are working the gig economy. You know, I got people who are self-employed and also driving Uber. Like, you know, it's some of this is enforced, right? Because I don't necessarily want to call myself a founder, which is everybody's favorite word now, but I don't have a choice, Rick. Like, what job am I going to get to give me $100,000 when I'm 25? There aren't many. Okay, and so they're doing this because they don't have a lot of choice but to do it. And so, you know, again, we're back to almost enforced entrepreneurship, right? Because of the way that the economies are.
Wow, that's great. Um, okay, that's cool. Scott, how do people find out more about you and what you do?
Hoyes.com. So Hoyes.com. We have massive amounts of research. We have educational videos. We have courses. We have a podcast. We have everything you could think of, because we're the only trustee firm that does the scale of research and educational stuff that we do. So you could go down a rabbit hole if you get onto our site and start looking around, dude. You could be there for days, and you can pick and choose, right? Like it's all there for you depending on your set of circumstances to check things out. We have like budgeting courses. We have like you name it, we have it. So that's what I would do. Hoyes.com. Everything you need to know about everything that I just said and more is probably there somewhere. It isn't all to do with insolvency. Most of it's to do with debt, really. Like, you know, it's more like, you know, prevention. Like, I don't need you to come into my website and file an insolvency. I'd like you to come to the website in order to avoid insolvency. Ideally, that's kind of the idea. And so, because, as we said earlier in the podcast, Rick, nobody really teaches you anything. Like, unless you took commerce or finance in university or something, you don't know this stuff. I didn't until I started in it. And even though I was in a business related business, so go there. You know, that information is based on a lot of experience, right? And, you know, I've done 8 or 9,000 filings. You know, Doug Hoyes has
That's
done
crazy.
probably 12 himself. The firm has done well over 100,000. You get a lot of experience from that, right? And so you can find it all out there.
Oh, cool. And it sounds like if people have any concerns, it's better that they talk to you sooner as well, right? If like
Sooner.
you have
Sooner's
some of
always
these red
better.
flags. And it sounds like
Yep.
you'll chat with them, do a consult, and talk about yeah, like what options they have, and just
Yep.
or what to prevent, right?
Yeah, it's all free, right? Like we're just talking. You can talk to me 10 times if you want. You can talk to me 10 times and never file. That's okay,
Okay.
right? But I'm going to tell you lots of good advice. And if you end up filing, fine. And if you don't, fine. But, you know, you have met with someone who is going to give you an honest opinion on what you should be doing, right?
Okay. Awesome. Scott, thanks for your time and coming on the show. That was
Thank
amazing.
you, Rick.
Yeah.
I appreciate the opportunity.